Thanks.
Thank you for joining us today. We're going to get started just past the top of the hour to allow people to dial in. If you have any questions as we get started, feel free to enter those into the Q&A, and we look forward to the session this afternoon. Thank you. Welcome and thank you to those of you who have just joined. We will be getting started just in about 2 more minutes, allowing others to dial in. If you have any questions as we start, feel free to direct those to the Q&A window in your screen. Welcome everyone, and thank you for joining our webinar, Creating a Best-in-Class Bank Fee Management Program. The typical large to mid-sized company maintains multiple bank relationships and spends most of their Treasury Department's annual budget on bank fees. But it is nearly impossible to do both your day job and stay on top of every billing error in your bank statement. Today's discussion is focused on how to improve that reality by building a bank fee management program. Our speaker today will be Jacob Nygren, a principal with Treasury Strategies and product manager for the NDEP Bank Fee Analysis platform. We encourage you to ask questions throughout the session, and we'll leave time at the end for a Q&A. Please submit any questions in the Q&A window at the bottom of your screen. This webinar is also being recorded, and you will receive a recording link as well as a copy of the presentation following the session. Jacob?
Wonderful. Thank you, Katie. Good afternoon, everyone, and thank you for joining. Today's session, as Katie mentioned, we're focused on bank fee analysis. And so what we're going to do is we'll go through and really define what is best in class when it comes to bank fee analysis. What does it look like in this modern era? And we'll go through and provide tips on how you can overcome some of the challenges around bank fee analysis in ways that you can improve your bank fee analysis procedures. And so with that, we'll first jump in and just conduct a general poll of the audience. We want to know how many of you actually do what we'll consider a true bank fee analysis. And so this is something, we're talking about something more than just reviewing looking at your last month's statement, the total line, seeing how that compares against your current month's total line, and if they're within spitting distance, then moving on. Like we're actually talking about a true deep dive bank fee analysis. So we'll give folks an opportunity to respond to that. While we do that, let's go through and talk through why bank fee analysis is important. As we see on the screen here, one of the things that corporate treasury knows inherently is that bank fees represent one of the single biggest expense categories that treasury incurs. And overlooking mistakes, not catching specific items or issues within your bank fee analysis statement can end up costing your organization thousands of dollars. Some organizations are also just required to do bank fee analysis. There may be a corporate responsibility component, regulatory component, but for some other organizations, it can just be a matter of helping to allocate costs out to different business units or regions across the globe and across the organization. So with that, let's see what some of the poll results said. Can we share? Okay, interesting. So about 50-50. We've got a pretty even split there. Some folks actually going through and conducting a regular bank fee analysis, and others, where we're still, that's more of an aspirational objective. And so we'll go through and cover off some specific areas and opportunities for both of the folks in those respective audiences. But before we jump in and get to some of the tactical challenges around bank fee analysis, I think it's helpful to level set with some of the specific macro challenges. And so we'll get a little academic here, but I want to talk about the overall pricing dynamics at play in the commercial banking corporate treasury space. And so when we look at the marketplace today and specifically how treasury management services are priced, we are really dealing with a very opaque market. Pricing varies dramatically. While banks do have standard price lists, emphasis on lists plural, oftentimes there are multiple standard lists that the bankers rely on. When we look in the mid-corporate on up in that space, most of the pricing there is negotiated or discounted in some ways. So we've got this pricing that varies dramatically throughout the industry. And as a result, it ends up misallocating resources and misstating demand. People spend a disproportionate amount of time on bank fee analysis or avoiding bank fee analysis. And in this new digital world, that's really an area that's open to improvement and positive disruption. And so this really is just an overall inefficient pricing scheme for all the players in the marketplace. Now, if we take a step back and contrast that against what represents the most effective and most efficient, economists generally agree on three main characteristics of an efficient pricing scheme. The first being that it's a commodity. So the good is well known. There's thin pricing. We think of like oil commodities or some of the other commodities that on the exchanges. They're well known and the pricing is well understood. The second component being that it's liquid. There's lots of activity. It's easy to buy and sell within those markets. And the third being that it's transparent. So a typical price is well known, easy to understand, and it's observable across all the market participants if pricing is out of whack. And so, again, economically speaking, those characteristics will produce an optimal market for both buyers and sellers because it keeps both sides comfortable that they're not really getting taken advantage of by the other side. Now, if we take a step back and review how that compares against the treasury management marketplace, so first up on a commodity basis, well, while the underlying services are the same in treasury management, a wire at one institution is a wire at another, they're often packaged and sold differently. They're sold under different names, and banks work to decommodify, and they want to be differentiated from each other. which is a great proposition, but it also introduces a lot of confusion into the marketplace. So there's certainly some room to improve on that front. The second component, liquidity. So while it can be kind of challenging to move some treasury management services, like if you've got a lockbox set up at one of your banks, but at the end of the day, there are multiple banks offering treasury management services. And if you do have multiple banking relationships set up, some services can be relatively painless to move from one institution to another. If we think about payments at one institution, issuing them from another institution instead. So we're doing a little bit better on the liquidity front. But on the third component of efficient marketplaces, transparency, this is one where there's really a lot of room for improvement. There's essentially zero transparency. Again, it's a very opaque marketplace. Prices are not well understood, with the majority of the market having their own specific negotiated pricing. And frankly, the benchmarking services are often lacking quite a bit. And so really there's some big opportunities here and areas for improvement so that both the buyers and sellers in this space can know that they're getting a fair deal. So then moving on, we'll talk about, obviously, we've got some challenges right there, but what are some of the specific challenges as it relates to getting into bank fee analysis statements? Well, first and foremost, we've got the challenging format. So anybody who has ever taken a look at, an EDI 822 file or a twist file knows how difficult those can be to decipher and understand. And not to mention PDFs, from your various banking partners, paper statements. We still see those sometimes, even in this digital realm. And so you've got all these different formats that aren't used consistently. Trying to have staff actually go through and manage and understand and parse through those statements. We've seen some statements that are 500 pages long from a single bank in a single month, some even more than that, right? And if you take a 500 or 700 page account analysis statement from one bank in 1 month, multiply that across multiple banks or potentially multiple business units and multiple banks, we can see how it can quickly get out of hand and make it very difficult to go through and decipher what specifically it is that you're paying for and how your pricing compares. On the note of comparison, the fact that banks do use the services differently, they charge differently, obviously that's a challenge in trying to do a bank fee analysis. And you may go through and find yourself spending all the time to be able to compile and build this analysis without much time left over to actually act on it. So lots of challenges there. Now, the interesting thing is if we take a look and consider the inverse, this actually affects bankers as well. Any corporate treasurer who has shared an account analysis statement with their banker and has asked them to, give me your pricing on these services, see if you can match or beat the current pricing that I have, or even worse, gone through and redacted some information, handed over a paper statement to their banker and asked them to work off of that. Well, if we put ourselves in those shoes, the banker then has to contend with this challenging format, potentially manually rekey that information into Excel or into their banking platform, try to see how their services compare with your existing bank services. There's just a lot of challenges on both sides of the equation here, and really does affect both bankers and corporate practitioners alike. So we'll get to some specific ways to overcome these challenges in a few slides, but when we look at what is best-in-class bank fee management, I think one of the first things that makes up anything, in order for it to be best-in-class, it's got to be something that's doable. It's got to be something that's achievable and that you actually are able to complete. If it's not efficient and productive and all these other components, you're not going to do it. And you can have the best bank fee analysis solution out there, but if you're not using it, obviously that's not just providing the value that you need. And again, remembering that this is typically Treasury's biggest single expense category, and mistakes do happen. Actually going through and conducting the bank fee analysis is really the first step in realizing what is best in class. Next up, it's got to be something that is timely, and the timing is a critical component, something that bank fee analysis should really be done monthly. And there's a lot of reasons for doing a monthly bank fee analysis. One of those is just to be able to identify mistakes when they happen and to get them addressed promptly. If we're talking about a mistake that costs your organization thousands of dollars, and if you're not prompt in responding and addressing that particular issue, you've also got an opportunity cost by any time that elapses between when that's identified and when it's actually addressed. In addition, one of the things that we advocate for is really understanding some of the trends. It can be as simple as just a time series. And so what we show here is a simple time series where we show from one period to the next the total service charges, balances, and ECR, so that you can see how any specific trends are emerging, also looking for any major shifts from one period to the next. And if you do identify a major shift, that suggests that you may need to peel the onion back and dig a little bit deeper into what's driving those underlying components and those shifts. Next up, tracking variances. So being able to identify a change from one period to the next and respond quickly. Also tracking your actual pricing against your negotiated pricing to be able to identify if there's any changes that inadvertently came through or any changes that weren't disclosed in advance. You want to be able to capture those and address them if there are mistakes present. And so one of the things that we do around this to help actually examine specific variances is just simply going through and matching up by bank each particular service and evaluating the prior month units, price, and total service charge against the current month units, price, and total service charge, and then really highlighting any significant variances between those. And so what you see here, the example that we call out, this is just one example of something that can and does occur frequently on account analysis statements. We look in the prior period, I had roughly 700 wires at $29 a piece. In this period, in I guess May in this example, we had 955 wires at $32 a piece. So it might have been that there was some pricing tier or something that had happened, but essentially, I had about $3 change in my per unit price, which cost me roughly over $10,000 for this particular period. So it's easy to see how some of these, what may on the surface look like kind of minor changes can really grow and end up costing your organization thousands of dollars if they're not being regularly monitored and kind of checking for those variances between one month and the next. Next up, efficiency. So we had talked about this a little bit earlier. If it's not efficient, it's not going to get done. It's got to be time efficient. You shouldn't have to manually rekey information into Excel. If you're getting paper statements and rekeying them, get electronic statements. Again, you shouldn't have to go through and do any of that copy pasting into Excel for bank fee analysis. There are tools and solutions out there to avoid that. And you also shouldn't need to go through in this current age and have to manage complex rules where this service from this bank equals this and treat it this way when it comes in. There are solutions out there to overcome that. But what about the challenge of, as we mentioned earlier, comparing across different banks? Anybody who's ever gone through the effort of trying to match up one bank's services to another on a one-to-one basis and get them to line up perfectly knows how fruitless of an effort that is. They're never going to match up perfectly the way that you want them to for the reasons that we talked about initially. Banks want to be differentiated from each other, and so they name their services differently. They don't use the AFP codes consistently. A lot of times they'll package and bundle different services together in different ways. In some cases we even see completely different underlying units of measure. And so what you get is it always ends up being a bit of an apples to oranges comparison for these reasons. And so you're not going to be able to force those line items to match up exactly the way that you would think you'd like to. And so what we advocate for and recommend is bring it up a level. Instead of just comparing apples to oranges, look at one basket of fruit to another. And the way that we do that is through calculating an effective all-in unit price for each major product and product category. And so we do that here. We give you the example of lockbox. We can see lockbox per item, in line with the asterisks here. That's my main volume driver. And I had 4,764 lockbox items for this period. Now, the bank charged me 4 different ways for that same volume, but at the end of the day, I had 4,764 items. Now, in order to calculate that effective all-in price, I'll add up all the lockbox-related service charges here in the far right column, total those all up, and then divide just by this line, which is my core volume, the 4,764. And that gives us our effective all-in price of $1.25. And so that way, by bringing it up to this level, we avoid a lot of that apples to oranges comparison, and it's much more comparable across banks rather than trying to force compare line items that simply are just never going to match up on a one-to-one basis. And it helps us to get back more towards re-commoditizing. If we think back to the earlier conversation, what we're helping to do is get back to some of the more well-understood specific products and services that are well understood and equally comparable across the marketplace. Now, in speaking about the marketplace, that's, I think, one of the important things that is worth spending a little bit of time on. So we've got a few slides where we dig a little deeper into this, but it's important to have a basis for comparison to really understand the context of your pricing and the overall pricing scheme, and understanding how your all-in product pricing compares against the market, as well as understanding how your volume affects your pricing. Now, talking a lot about pricing here, but there's also the other side of the equation as well, understanding the value of your deposits. How are you being compensated for those deposits? How does your earnings credit rate compare? What about the balance-related fees and your net effective rate? Understanding how all of those specific items compare against the marketplace helps to keep you informed and make decisions more appropriately, and frankly, have more productive conversations with your bankers. So when we look at benchmarking, first up we show here all-in price benchmarking. This is for disbursements and checks paid. And one of the things that we advocate for is a bit of a rethinking from how benchmarking has historically and traditionally been done. There's a lot of benchmarking services out there. Most of them try to force compare those apples to oranges, which leads to very imperfect results. A lot of times you'll just get a straight percentile for a specific AFP code, and it'll say the market median price for this service is X. Well, the issue with that is that it ignores the volume component and the impact that volume plays on commercial and treasury management pricing. And so what we do is advocate for looking at benchmarks as curves. And so what you'll see that we show here, the middle red line is the market median, the bottom blue line is the 25th percentile, and the top blue is the 75th percentile. And as you can see here, they form a curve, and the more that you have in volume, typically the better pricing that you can expect. And even just to compare against that, the 50th percentile, If I only have 1,000, in this case, checks paid, or even just 100 checks paid, my pricing is very different than if I have 10,000. And this really goes to illustrate the impact that volume has on pricing. And so, what we call out here as a specific example, in this case, since we're talking about fees that you're paying, you don't want to be above the top blue line. In general, we say if you're between the two blue lines, you're more or less at the marketplace. But if we look at this example with fictional Tri-Central Bank, with roughly 4,000 items per month, paying roughly $375 per item, if we were to move them straight down to the market median, so same volume levels, we're comparing against like to like, we're comparing ourselves against what pricing other folks in the industry receive at similar volume levels. At the market median, my 4,000 items, instead of being priced at $3.75, should actually be closer to 75 cents. And negotiating this outlier or having a conversation with your banker to remove paper-based reporting or whatever might be driving this cost up, just bringing that all-in price down to the market median would save over $85,000 over the course of a year. So there can really be some major opportunities here. Now, as I mentioned, the fee side, that's only one side of the equation. It's also really important, arguably as important, to review your ECR and understand how that factors in and how that compares against the market. Now, in this specific example, we see that the curves actually slope in the other direction, which makes sense as you think through, if I have $100,000 in balance, I'm going to expect a very different market ECR than if I have 100 million in balances, right? And so you can also think through when looking at your banks, which show up as stars here in this particular report, and do some what if scenario modeling. If I were to consolidate all these different banks and my balances together, I can kind of project and move out either forward or backward along the lines to see what types of rates should I expect at my consolidated balance levels. So the idea of looking at your benchmarks as curves really does add a lot of value, and I think that's one of the things that the industry as a whole has been lacking is that kind of volume-based context for understanding how their pricing compares against the market. And certainly we mentioned here negotiating this outlier here, and it's Tri-Central once again. Just bringing this particular ECR up to the market median would be an additional $15,000 in value through earnings credit offsets over the course of a year. So again, there can be some really powerful value propositions by just utilizing this type of benchmarking and reporting. Next up, net effective rate. So this one is one that is often overlooked by folks as a part of their bank fee analysis, but is one of the more powerful types of analysis that you can do on a monthly basis. And what this is understanding what is the true yield on your deposits. While folks really do pay a lot of attention to the earnings credits that they're getting or the interest that they're receiving on their accounts, it's often overlooked that for most banks, at least in the U.S., you're also most likely paying a balance-related fee as well. And so this balance assessment fee, this is a fee that the bank calculates. It's based off of your ledger balance. And while earnings credits are paid off of your collected balance. So that means you're also paying for any float that's out there as well. And really this balance assessment fee, as we show in this particular example, we've seen on multiple occasions where this balance assessment fee wipes out any benefit that you get in the form of earnings credits, which means that you may actually still be paying your bank to hold your balances for you. And this is one of those things where we've mentioned you can negotiate or redeploy this cash. In this case, this particular example to the tune of roughly $84,000 over the course of the year of additional benefits by just trying to work through and at least not paying out for holding your balances, your deposit balances at your bank. Okay. Now, with all those differences and differences in net effective rates, there can also be some big differences by industry as well. And I think it's important to understand the dynamics at play within your own industry. And so what we show here are the industry net effective rates. And so one of the things that we want to call particular attention to is we're comparing ourselves against the industry median here, the overall market median, which is the red line. And one of the things that kind of jumps out as we dissect this a little bit is you've got this weird outlier here with the insurance companies. And so at the lower end of the balance levels, at lower balance levels, insurance companies tend to get much higher net effective rates than peers and than the industry overall. But at the higher balance levels, that actually tends to be much lower. And now we suspect this is likely attributable to the fact that insurance companies, specifically those that have significant balance levels, many of them are holding those balances as custodial balances, which they're not, by regulation, not able to earn compensation on, since they're custodians on that cash. But understanding that dynamic is important to kind of frame the context and the conversation with your bankers. Now we contrast that against, the real estate line here, this blue line, at the lower end and lower balance levels lag the market median, but on the higher end exceed the market median. So there's an interesting contrast there. And unfortunately, healthcare and education just both fall well below the overall market median in terms of the industry net effective rates. So again, there can be a lot of valid reasons why net compensation varies by industry, but it's important to understand how your firm compares to the broader market and frame your conversations with your bankers within that context. And then one of the last elements here that we want to mention, because we do see it quite a bit, is a lot of folks with excess earnings credits. Now, in a lot of cases, not all cases, but excess earnings credits are usually wasted. Some banks and some companies negotiate with their banks to allow those to roll over from one period to the next, but in most cases they do not. And what this essentially means is that if you have excess earnings credits, a portion of your balances is effectively earning nothing for you. And we cite this particular example where this, we've masked the client and the names obviously, but had 14,000 in excess earnings credits for the month. Now, running the math, that translates to roughly 26 million in unutilized balances. And just taking those unutilized balances and investing them, whether it be in a prime fund or a government fund at 2%, that's an extra $500,000 over the course of the year. So there can really be some substantial value tied up in this, and it's important to go through and understand and conduct that analysis. Next up on the list of best-in-class and best practices, once you've done the analysis, it's really important to have some transparency around that analysis. If you identify that excess cash and redeploy it, celebrate those wins. Make sure that you're getting credit for those changes that you've made that have improved or added to the bottom line. But then also make sure that you're having candid conversations about the specific opportunities and areas for improvement, not just internally, but having a candid conversation with your bank partners as well. That's really how we move to an environment where you can really have some productive relationships with your bankers. And that obviously being kind of the final point here that we do want to touch on is that if executed properly, if you're going through and really embracing these ideals that we bring forth today, bank fee management should be productive for not only your organization, but should also enhance your relationship with your bankers. At the end of the day, as corporate treasury professionals, you want to know that you're getting a fair deal with your banks. And we all understand that our banking partners need to be paid, they need to get compensated for the services that they're offering, but we just want to know that we're getting a fair deal that compares to our marketplace. And by embracing these practices that we've gone through today, it ends up being better for everyone, buyers and sellers alike, having those transparent, candid conversations with your bankers around what your specific opportunities are, your room for improvement, and also what's going well. So with that, we'll go through and talk through a few specific case studies where we've seen folks actually embrace what is best-in-class bank fee management and some of the results that they've been able to realize from that. So the first one here, this is a global Fortune 500 material and chemicals company. And historically, they were like roughly 50% of the audience here. They hadn't really done a lot of bank fee analysis. They would occasionally scan their prior month account analysis, look at the total line, compare that to the current month, and if it was close, okay, we'd move on. Well, they had gone through and signed up for the end of product, and we ran their first set of reports, and they actually sat down and reviewed the results of that report with their bankers. And in going through that report, the bank acknowledged there's some room for improvement there, and the bank agreed to adjust some of the service level pricing, I believe as it related to their lockbox, if my memory serves, and then also aligned their ECR to more closely match the industry for their specific balance levels and their average balance levels. And as a result, it ended up saving them roughly $126,000 over the course of the year, just on their first report alone. And this is one of those situations where everybody was able to walk away with a win, which is really nice. They were able to redeploy those savings to implement a global payment solution, which they had been talking through with their banking partner for quite some time. And so, everyone was happy in this kind of scenario. And that's really where having these transparent, candid conversations can really start to take shape and be beneficial for all sides. Next up, we had a real estate company, and very similar situation. They would go a little bit deeper into some of their account analysis and just try to do a spot check of some of the major lines from one period to the next, but they wouldn't really go deep and conduct a full variance analysis and those types of practices. And what we found in going through their reports is we sat down and looked at their first set of reports together, and they pointed out a lockbox that they had that we were saying they had at a specific bank. And they're like, we don't have a lockbox at this bank. Well, we pulled out the original account analysis, went through it, and sure enough, there was some very low volume lockbox items still being processed at this bank. And so what they did was they went through and actually closed out that lockbox, consolidated the volumes with one of their larger lockbox providers. And since lockbox tends to have very high fixed costs, which really costs you if you have low volume, they were able to realize cost savings of thousands of dollars just off of that one item alone. So there can be, again, some real powerful value propositions here. Now, the last item in the case study is we have a very large global technology company. One of their big challenges was they've got multiple banking relationships across different entities, different countries around the globe, and obviously multiple currencies. And so what they're able to do is just load in all of those statements, just dump them into our system, and through that effort, we identified over 100,000 of monthly excess earnings credits that were essentially being wasted each and every month. And in running the math, we identified that translated to roughly 60 million of excess unutilized balances. And so when they went and redeployed those balances into money funds, that yielded, over the course of a year, an extra 1.2 million of additional revenue. So just massive results, which you know, can be identified by going through these type of bank fee analysis efforts. So, in summary, you know, bank fee analysis, we've talked about how it really is important to every organization. There can be some, and not only is it important, and for some organizations it's required, but if it's done right and done with transparency, you know, there can be huge payoffs by going through these exercises. And in fact, failing to manage these fees can end up costing you just thousands of dollars. And there are some very good technology solutions that are available in the marketplace. One of them, which we'll kind of get to now, is this is our own kind of shameless plug, where we'll mention that one of the solutions that's available out there is our bank fee analysis tool, which we call In-Depth. And this is a tool where you can load in your PDF account analysis, EDI 822 or Twist BSB files. You just load them into the system, and you get back your reports and your results. There's none of the manual mapping. There's no implementation that you need to go through. It's what we call here is just managed bank mappings. It's all centralized. It's shared mappings across all of the clients that are using the tool. And as a result, you can be up and running in just, you know, a 10-minute registration process and start getting back your reports immediately. And those reports contain some of the things that folks really are looking for out of their bank fee analysis program: the month-over-month variance report, the benchmarking, and specifically the benchmarking curves. And you know, what's nice is that you can even get in and get started with some of these solutions completely free. You know, with the rise of freemium, quote-unquote, freemium products in the marketplace, you know, this is one that we're pleased to offer to corporate treasuries, and we understand how important that can be. So it is, I think, really important, and I think we all kind of see how there's never been fewer barriers to entry, and bank fee analysis is one of those items that, for corporate treasury, continues to be high on the importance list. We just need to make sure that it's a priority as well, and that's where technology really can help to make this a process that is efficient and painless for treasuries that we all know are short-staffed on an ongoing basis. So with that, I'll pause for a moment. Katie, have we had anyone post any questions as we've gone through the session today?
We did have a few questions. So actually going back to the middle of the presentation, I think it was pages 16 and 17, one question that came in was regarding the balance fee. Isn't that a pass-through FDIC charge? Can we really do anything about that?
Sure. Yeah, that's a great question, and we actually hear that a lot. So it's interesting that that particular charge, we call it a balance assessment fee, but like I mentioned, it comes under many different names. It originated as an FDIC charge back in 2008. Well, about a year or so after that, the FDIC actually rolled that back and no longer charges that item, but banks have still held on to and continue to charge it. And so we do have evidence now that it's not a pass-through charge. It is something that you can negotiate. In fact, we've even seen some banks that don't charge it at all, but the majority do. And some of the evidence that you can point to, you know, if you're having this conversation with your bank, or you do hear that it is a pass-through charge from the FDIC, we know that it's not an FDIC charge because the FDIC only covers the first 250,000 balances, whereas this fee is charged against your entire ledger balances. So that's one item. And also when we run those benchmark curves, we do see a wide distribution between the 25th and 75th percentile. And so we know that there's room for negotiation. If it were a pass-through charge, it would be just a single straight line and everybody would be on it. And so there are some ways in which you can kind of have a frank, candid conversation with your bankers about that.
Thank you. And a second question was related to the industry-specific curves, and what do those represent?
Sure. Yeah. So those curves, they are specifically, and I'll pull that back up just so everyone can see it here. What these represent are the industry medians, and so we show here the red line is being the overall composite median. This is derived from all of the users of the in-depth database, and then we broke out specifically the medians from each of these respective industries and compared that against the overall median. And so that's the kind of the nature of the benchmarks. As it relates to the benchmarks overall, as I mentioned, with in-depth in particular, given that we're a tool that is both a bank fee analysis tool as well as a benchmarking platform, all of our users, our 170 plus users, both contribute to and receive the benchmarks from the tool. So it's a bit of a different approach, and one that we've seen really does add a lot of value and helps folks to better manage their bank fees and again capture value from the opportunities that are present there. Any other questions?
I think that actually covers the questions for this afternoon.
Wonderful. Well, thank you all so much for your time. I know that we will be distributing the webinar recording as well as the deck following the session today. But we want to thank everyone for their time and wish you the best of luck in kind of working towards and following your journey towards best-in-class bank fee management. And we hope you'll consider in-depth as one of the tools that can help you achieve that. So thank you all once again, and hope you have a wonderful afternoon.